So Module 2, the basics of development finance. So development finance is used where you are essentially trying to do any kind of build works or conversion or development to a property. So they will lend you a portion of the purchase, normally 50-60% of the purchase, and 100% of the build costs, as long as it fits within their 65% loan to GDV, which is your gross development value, which is what it's worth when it's finished. Now, the only difficulty with development finance, well, lots of difficulties, but the biggest difficulty with development finance is that they release those development costs in tranches in arrears. So it means you have to cash flow the development, or your contractor has to cash flow the development before they then release the money back to you in order for you to carry on the works. So where you're using development finance, new builds, commercial conversions, refurbs, those kind of things where there's a purchase price, some build, and then an increased value come the end of it. And when it comes to development finance, one of their biggest things is going to be, are you selling it or are you refinancing it? Development lenders don't tend to do development finance and commercial exits as well, so you would often use two lenders in order to do the development and then the exit if you were deciding to keep them. But that's pretty much just a very quick summary of what development finance is used for and the tranches in arrears. So when it comes to the cost of development finance, there are a few extra costs than when you're using bridging finance, for example. So the first one to keep in mind is interest rates. So interest rates can be fixed or variable, so similar to bridging finance or buy-to-lets or commercial mortgages. So the first thing you want to work out is the interest rate fixed or is it variable? Now, if it's variable, it tends to be an interest rate over the Bank of England base rate, which at the point of recording this is about 4.5%. But obviously it's going to fluctuate, I would imagine, over the coming months and years. So first thing to work out, fixed or variable, that's one of the most important things. Those interest rates normally sit around 9-10% per annum, again for development finance. The next part is arrangement fees. So similar to bridging finance, your arrangement fee is going to be about 2%, and that's normally on the gross facility, which is your 50-60% of purchase plus your 100% of the build. So the arrangement fees are substantially more than you would expect on say like a smaller bridging loan, for example. The legal fees also tend to be significantly more as well. So on a bridging loan of £1 million, for example, you would expect legal fees of probably about £2,000-3,000. On a development loan of £1 million, you would expect legal fees of around probably 4 to 5. So as a rule of thumb, the solicitors tend to charge a bit more money when it comes to doing the legals of a development loan. There's no massive differences in the legals, but it just tends to be that there are a few more questions, a few more questions around the exits, a few more questions around the source of funds, a few more questions around the contractor, maybe around doing the collateral warranty, so the step-in rights, which we'll cover a little bit later on. So the legal fees do tend to be higher as well. The other thing that is higher is the valuation fee. So when you do a standard bridging loan, the valuation is just what is it worth right now. Whereas when you do a valuation for a development loan, it tends to be what's it worth now plus what's it going to be worth once you've done the build. So they're essentially doing two valuations within one, and that's obviously reflected within the price. So valuation fees are significantly more as well. So the last professional that you will need to add in that's a little bit different to bridging finance, for example, is you will have a quantity surveyor or a monitoring surveyor. Now, the quantity surveyor is there to go out to check your build costs, to make sure that your build costs are correct, to make sure that the lender could, if they had to step in and take over the development, could still deliver it for a sensible build cost. So the quantity surveyor is there to check that your build costs are reasonable. So if you've got a mate building out your development and they're charging you less than the sort of average market rate, then expect the QS to come back and question it, and the lender to potentially want to lend you a little bit more, just to make sure that if they had to take it over, they could cover the higher build costs if they would take it to someone else. So you'll have that initial fee, which is about £2,500 for them to go out and check over your build costs. You'll then, if you have a monitoring surveyor as well, which if on any kind of medium to large development you will have, they will come out and deal with all the tranches. So there'll be a monthly cost of potentially £800 to £1,000, or every tranche that you draw down, they will come out and they will charge you to do that as well. So they're pretty much most of the costs that you need to keep an eye out for, but in one of the later videos that we do when we talk about advanced development finance, we'll go through a set of terms and go through those costs in a bit more detail. But they're the main ones that you want to keep an eye out for. So when it comes to commercial conversions, refurbs and new builds, there's a few things to keep in mind. So the first one is the difference in lenders. So There are some development finance lenders that are happy with refurbs, there are some that are happy with commercial conversions, there are some that are happy with new builds. There are also some that are happy with all of those. But it's worth keeping in mind that every development lender has their speciality, their niche, and what they're best at. So when going for lending, just keep in mind that there are lenders who are better for new build, there are lenders who are better for commercial conversions, and there are lenders who are better for just straightforward refurbs. And there's also a difference between a light refurb and a heavy refurb. So light refurb is anything cosmetic, nothing structural, probably where the build costs don't exceed, say, 50% of the current value of the property. So if you've bought something for 200,000, as long as the build costs are under 100 grand, tends to sort of fall into that light refurb. Heavy refurb is anything structural or anything where potentially the build costs are more than the value of the property. So there are lenders again who specialise in different elements of that as well. And obviously there are different costs involved in obviously the different kinds of lending you get. So for example, going for a refurb loan may be cheaper than going for new build development finance. Maybe the other way around, maybe that the new build finance is cheaper than going for refurb finance. So again, just keep in mind that there's a huge difference between all of the lenders in terms of what they specialise in and what they're going to charge the most for and what they deem as the most risky in terms of a product. And the last thing is the difference in what lenders require. So for a refurb, for example, they're going to require a breakdown of the works, but they're probably not going to require a quantity surveyor to go out. They will probably be happy with just sending someone from the office to go and have a look around the property and make sure that it looks okay. Whereas a commercial conversion or a new build, they're going to want quantity surveyor to go out, do full reports, they're going to want red book valuations, they're going to want every T crossed and every I dotted. So refurbs we tend to be able to get away with a little bit, whereas new builds and commercial conversions we really can't get away with a huge amount. And obviously each one as well brings a different level of creativity. So we can be more creative on a refurb with our finance solutions than we maybe can be with a new build. So there's lots of different nuances within every element of it, but all of these are all covered within the umbrella of development finance. So commercial conversions, refurbs, new builds can all be financed with the same products, but there's just a slightly different requirement that you need to keep in mind for each one. The application process when it comes to development finance is much more in-depth than a bridging loan, for example. So there will be a requirement for an application form, there'll be a requirement for GDV breakdowns, including your square foot, your square meterage, the individual unit breakdown in terms of cost if you're doing a commercial conversion or a new build, copies of the planning permission, copy of the pre-commencements being ticked off, copies of all of your different insurances, where you're going to go for your new build warranties come the end of it. There's all of these different bits of paperwork that you require that are much more in-depth than you would expect from a bridging loan. Two of the ones that I want to kind of tick off and go into a bit more detail on are your build cost breakdown and your GDV breakdown. So build cost breakdown is incredibly important and it is an evolving document throughout the process of your development finance application. So when you first go for development finance, your build cost breakdown will be incredibly simple. It will probably be a pound per square foot, for example. It will be, if you're working off of £150 a square foot, 180, 210, whatever it may be. It will just be more than likely a pound a square foot. What will then happen is once you've gone for development finance, once the application process has begun, you will then go through a process where you then go out to tender, which means you then go out and approach maybe 3, 4, 5 builders and get them to tender what they believe the cost of that development is going to be. So at that point you then have a second build cost breakdown, which has normally come from the builder and will normally be more itemised and more detailed. You will then end up having to go to the QS, so as part of the development finance application process, they will then have a quantity surveyor check over those costs. So at that point, you'll probably actually end up with a third set of build costs. So at that point, the QS will go out, they'll look at the figures and they'll say, well, actually, we think this should be this, we think that should be that, and you'll actually end up then with a third set of build costs. So throughout the application, you're actually going to end up with your simple set, your tendered set, and then your quantity surveyor set. And that's normal throughout the process. The second one is your GDV breakdown. So again, when you first start, very similar to your build cost breakdown, when you first start it'll be very simple. It will probably just be, we believe the GDV is £2 million, £1 million, whatever it may be. And chances are it won't be split down particularly between the units. Then as you go through the application process, obviously the valuer will then come out to the property and they will say, okay, well we believe the property is worth XYZ. So at that point you end up with a more detailed GDV breakdown, which Normally a step before that, you will probably go to a couple of estate agents, for example, and you'll create a more detailed version of the GDV breakdown for yourself. So you'll end up with your sort of this is what we believe the GDV is, with no kind of evidence or background. You'll then end up probably going to an estate agent, getting a slightly more itemised GDV, and then you'll end up going to the valuer, who will then give you your final GDV, and will come back to you and say, well, we believe that the GDV is this, and this is how it's broken down, these are the comparables. And that valuation is normally 60 odd pages long. It's a fairly chunky document. But as a rule of thumb, they're the two breakdowns that are probably going to evolve throughout that application process. And other than that, it's your usual things like your application form, which you'll just have to pop on, your CV, which we'll go into a bit more detail about in a later video, and experience of the contractor, which we'll go into a bit more detail about in a later video as well. But in a nutshell, that's the application process. Significantly more in depth than when you go for a bridging loan valuation or a buy-to-let valuation. So most definitely, when you're prepping for this valuation, you need to create a valuation pack, because there's just no way that you can't, because you're going to need comparables, you're going to need your schedule of works, you're going to need your schedule of unit sizes, you're going to need your CGIs, your before photos versus your after CGIs, especially if it's a new build or a commercial conversion, because you've got to create this vision for the valuer to see and for them to understand what it is you're going to build. They're also probably going to want to see CGIs of finishes as well, because that's very important. If you're building a 3-bed house, it could be a medium quality finish, it could be a high quality finish, and that could be the difference between the house being valued at 200,000 or being valued at 230, 250. So as well as giving them kind of CGIs as what the development as a whole will look like, be sure to go into a bit more detail about the level of finish, because they're going to want to understand that in order to then put a value to that. So when it comes to your comparables, try and keep it sensible. Try and keep it within 0.5 to a mile at most of the area that you're working in. Make sure that the square footages are the same. Make sure that you're using something of a similar standard of finish as well, because it's incredible how many times we have people bring comparables of very, very high-end finishes, but they're only anticipating a low-end finish. So make sure that it's a similar level of finish as well. The schedule of works is incredibly important as well, so I would, at the point that you give them to the valuer, I would make sure that you're probably at tendering stage when you send those over, because the build costs are what they use to determine the residual valuation of the land. So the residual valuation is based on what they believe the GDV is, less the developer's profit of, say, 20%, less the build costs, then gives a residual valuation, which in its simplest format is what someone could afford to pay for that land. So the build costs need to be pretty accurate in order for them to come up with a accurate residual valuation. And that's what the lenders will use to lend off of when they lend you that sort of 60-70% day one. The unit sizes are incredibly important as well, because they'll need to understand how large the units are going to be, and they need to understand, obviously, when they're looking for their own comparables, what they're comparing with. And CGIs, as we mentioned, are very, very important, because you need to be able to create that vision for the valuer, for them to say, okay, this is what it's going to look like, this is what I'm looking for in terms of comparables, and this is what the finish is going to be. So I would always implore anyone to create a valuation pack when going for development finance, because there's just too much information to not be able to do that. And as part of this, what I'll do is we've just recently had a valuer provide kind of a list of information in order to go out and do a valuation on a development site. So what I'll do is I'll convert that into a PDF and I'll pop it in the resources that you guys can see on the left hand side of the screen. And yeah, have a look through it, try and create some template valuation packs. And I'm more than happy to have a look through and kind of give you any guidance if anyone does create one. But yeah, I'd have a read through and just get familiar with that. But all in all, that's what you need to do to prep for a valuation for development finance. So the offer and legal process with development finance is much more intense, as we mentioned previously, than bridging finance and buy-to-let, for example. So the legal process can be longer, more intense, more questions, more things to answer and show. And we mentioned earlier about CPSE, which is the Commercial Property Standard Inquiries. These are an absolute must when it comes to development finance. So you will tend to find that these will always be required to be answered, and they can be quite intrusive. There's a lot of questions that need answering, and it tends to be that the vendors of sites can be quite slow in answering these as well. So it does tend to drag the legal procedure on somewhat. So when it comes to the offer, we'll start off with that bit. The offer will come over to you. It will detail everything, hopefully, the same as the agreement in principle when you were first kind of issued terms. Hopefully it'll be the same. But that offer is the bit that you really need to read in detail so that you can understand how much you're getting net day one, so you can understand how much you're getting for your build costs, understand when the tranches are going to be drawn down, the cost involved with each tranche, the cost involved if you don't draw down any of the tranches, because normally as a rule of thumb, development finance, you only pay interest on what you've drawn down. There's no non-utilisation fees or anything like that. But that offer is the bit that you need to read to ensure that there aren't any of those fees. Once you're happy with the offer, that's when it then goes into legals, that's when the inquiries start flowing, and that's where you start to get involved in doing your searches, for example, answering the inquiries, managing the vendor's expectations and getting them to reply as quickly as possible, and starting to go through, obviously, signing the personal guarantees, your debentures, the collateral warranties. The collateral warranties we will go through in a bit more detail later, but they're essentially step-in rights that your contractor and architect may sign, which means that if you can't fulfil the development for whatever reason, that they can step in and carry it on alongside the lender or a future purchaser. So once all of that's done, once you've had your independent legal advice, that's when the legal process sort of comes to its end point, and obviously there's going to be no end of further inquiries, and there'll be things around the contractor, no doubt, and maybe things off of the results of the searches and whatnot. But hopefully the legal process won't take too long, as you can manage the vendor's speed, and obviously we would assist in managing the lender's speed. But hopefully the legal process shouldn't take too long. But you will find it much more intense than if you're going for a standard bridging loan. Hence, the cost of that legal process is significantly more than other finance products. You will also be expected, similarly as you would be on bridging finance or a buy-to-let, for example, you will be expected to pay for the lender's legal cost as well. If you've got any private investors, which you may have, then there may be deeds of subordination, which is essentially if your investor is coming in on a second charge and your development lender is coming in on a first charge, a deed of subordination is a deed signed between the two of those to ensure that they both are respectful of their position within the charge holding order. And it just means that the second charge holder can't do anything to affect the first charge holder. So there'll need to be some documents signed between those as well. And obviously if you've got an investor as well, they'll need to take independent legal advice, etc. to come into it as well. So that can add some time onto that legal process as well. But all in all, that's the offer process and the legal process. So a summary of the pros of development finance. So one of the first ones is speed, and we've mentioned about the legal process being quite slow. However, if everyone is managed within the process well enough, actually development finance can be quite quick, and as long as valuers are quick and quantity surveyors are quick, then it can actually be a decent process and can go through in 6 to 8 weeks. But there's a lot of management involved in that. One of the other pros of it is dissimilar to bridging finance, which is only against the purchase. Development finance gives you something towards the purchase as well as something towards the build. So it's handy for leveraging up and doesn't require as much of an equity input on some deals as bridging finance may require, for example. And the last one, and this is probably one of the most important ones, is actually if you get the right lender in place and if you get the right support network in place, there are lenders who will support you through the development. And some are developers themselves, some of them have got developments going on in the background, they've got a good team, and they'll actually work with you rather than against you to deliver these deals. And it just means that if anything starts to go wrong, or if things slow down, or if you've got any questions, queries, worries, you can actually go to the lender and actually have that support network kind of already ready-made. So that's probably one of the biggest pros of development finance, is actually that access to a network that can help you if you're doing a first-time development, for example. One of the last pros of development finance is actually that they will work with you to do your due diligence on your site. So they will check comparables, normally within the lender's asset management team. They'll check comparables, they'll check build costs, they'll check a lot of the basic elements, which actually allows you to do some very quick due diligence on sites. And whilst I'm not suggesting that you should send every single site to a lender that you're not going to do, it can sometimes be handy to do a quick bit of due diligence if you're unsure on something and you maybe want them to pick something up that maybe you've missed. So that can be another pro as well, is again, as part of that support network that the lender brings, is actually that ability for them to do some of the due diligence. So all in all, that's the summary of the pros of development finance. So the summary of the cons of development finance. So as well as the pro being that it can be fast, it can also be slow. So there are a lot of cooks within the process. There's your valuer, there's your quantity surveyor, there's the lender solicitor, there's your solicitor, there's the vendor solicitor. All of these people who have all got to work together really quickly in order to get the deal through. And naturally there's going to be delays with some of them through the process. So the only problem with development finance is if all of these people aren't managed correctly, it can be a really slow process as opposed to a really fast one. The other problem with all of these professionals is obviously each of them wants their slice of the pie. So as well as it obviously being slowed down by there being so many people, it can make it more expensive as well, because you've got to pay for the quantity survey, you've got to pay for the monitoring surveyors, visits on each tranche drawdown, you've got to pay for both sets of legals, you've got to pay for obviously all of the other bits and pieces that come up throughout the process, and there may be commitment fees and things like that as well. So it can get quite expensive. The other con, similar to bridging finance, is that defaults, delays, etc. can cause massive issues and massive financial implications. So if your development runs over, for example, you could be charged default interest rate, you could be charged extension fees, there may even be repossession. So it's worth keeping in mind an exit plan and an exit strategy as well, to ensure that you're safe if there are any delays or any sort of reason to extend. So you could look at development exit finance, for example. That's the equivalent of a bridge, which allows you to get out at the point where you hit practical completion, almost like a sales bridge. So you put it on a bridge while you're putting the property up for sale. It may be that if you're building 2 and 3 bed houses, that as well as putting them up for sale, you may decide that you want to keep some as well. So it's worth keeping in mind all of these different exit strategies, just in case you get to the end of development finance and maybe you've got a 12-month term, you get to month 12, you've only just finished the build, you need something to enable you to then go and sell them or refinance them. The way to get around that is communication. So actually a solution to defaults and delays is making sure that the lender is constantly kept within the loop, and making sure that they know if there's going to be a delay, if they know that there needs to be an extension or something like that. Because if it hits month 12 of a 12-month term, they're going to be less amicable to doing an extension or not charging default interest rates. Whereas if you went to them at month 6 or month 7 and kind of preempted that there was going to be a delay or a requirement for an extension, the way to get around that as well is when you approach a lender for development finance in the first instance, make sure that when you look through the agreement in principle, when you look through the offer letter, that you understand the terms of a default or an extension. And as long as you've got that knowledge and obviously work with the broker, then hopefully you can avoid any financial implications of those moving forward. But that's just a very quick summary of the cons of development finance.